Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we're taking a look at the world of brands and how this relates to the world of investments. In order to do that, we have Phil Bach, the CEO of Exponential ETFs, who walks us through the brand value ETF and how it looks to find companies that have solid brands and might be seeing their stock prices traded at discount. So, if you have any questions or comments, make sure to send them in to podcast@zacks.com. And don't forget to find the Dutram Report on iTunes and give us a review there as well. But stay tuned for my chat with Phil right after this. Okay, Phil, thanks for coming on today. So you're here to talk about a new type of smart beta strategy that recently hit the markets, and that is this idea of focusing on the value of a company's brand. Now, why do you think looking at a given company's brand is an important part of the investing process?
Well, hi, Eric. Thank you for having me on. What we're doing at Exponential ETFs is we're trying to find ways to look at the market beyond cap-weighted that are rules-based and that follow systematic processes and use an informational advantage that should work, all things equal, that should work in any market environment. And where we've really found the opportunity to be is in quantifying intangible assets. There was recently a government study that estimates that $8 trillion of the economy is tied up in intangible assets. And if you look at private company valuations, a very significant portion of those valuations of companies is tied to intangible assets. But in the public markets, when you break down the fundamental and the technical factors that are in most stock valuation models, the intangible assets are almost completely missing. And what we found is that measuring the brand value, being able to quantify the brand value of a company can bring significant alpha to a portfolio. And it also serves as a leading indicator rather than a lagging indicator for security valuation.
So why do you think people have been overlooking this aspect for so long? I mean, as you said, it's multiple $1 trillion. It seems like it's a big area, and it seems like something people would want to take note of. Why do you think it's been so overlooked?
Well, the difficulty is in quantifying the brand value and in quantifying it with a methodology that is uniform across all market sectors and all companies. Any company can pretty easily get a handle on the value of their own brand and how that's impacting their sales, and accordingly they invest a lot of money into refining their brand and measuring their brand, but what they can't do is measure their competitors quite as accurately. So what we've done through a partnership with Brandometry is we've been able to quantify that brand value and apply it systematically to the market.
Yeah, it seems to me that it would be pretty difficult to compare, say, a Boeing with a Procter & Gamble in terms of which one has the stronger brand when they're in such different industries. So how do you guys look, with your partnership with Brandometry to find the most powerful brands? What kind of factors do you look at in particular?
Well, what we do is we take what we call a brand power score, and we start with researching influencers in the space, and we do several thousand interviews every year with key thought leaders in the marketing space, and we get a good handle on familiarity, favorability, reputation, perception of management, and then ultimately we funnel that in. We start with in terms of putting together the index, we start with a universe of the Wilshire 5000. Then we apply the brand power scores that come through a partnership with Brandometry and their partner, which is Tenant Partners, and they quantify, they're experts in quantifying that brand value using those factors. And then we take that and we compare the brand value to the market value of the company. And what we're really looking for in the brand value ETFs are opportunities where there's a divergence, where there's unrealized brand value that we feel is not yet priced into the market. Yeah, so can you talk a little bit more about some of the surveys that are done? You said market leaders. What does that actually entail? And do you have an example of maybe some of the types of questions or anything like that are asked? It just seems very hard to quantify across sectors. So any insights here I think would be great to have. Sure. So for the Brand Transact 50 index, which is the index that the brand value ETF tracks, we start with a list of, like I said, key influencers and thought leaders, which are senior-level executives at corporations that are familiar with the different brands in their sectors. And we don't allow people to comment on their own companies or companies that they have a vested interest in, but we are looking for the people that are the most knowledgeable and the most up-to-date with their finger on the pulse on what is going on with the trends of the brands, which includes not just, the marketing and the logo, but also the perception, the social presence, the perceived quality, the pricing power, and the innovation that goes on in those companies. Those are the factors that go into the overall score.
Okay. And yeah, let's talk a little bit more about the ETF you guys have to track this approach, the symbol BVAL, the brand value ETF. So the fund holds 50 stocks in its portfolio, equal weight, And the idea is to find the companies with the most unrealized value as opposed to the most total brand value, right? Why did you guys decide to go with the unrealized as opposed to just looking at the companies that have the most valuable brands per se?
Well, what we're trying to avoid is investing in companies that are potentially overpriced or where the brand value is already priced into the stock price. So, for example, if you take a look at Apple, Apple's got a fantastic brand. Everyone knows that it has a fantastic brand, and you could argue that that brand is priced into the forecasting of the stock, and certainly a lot of the loyalty that they have with their customers is already priced in. So, what we're looking at is we're looking for companies that have the anchor of a strong brand but have declined in stock price, and you can use them as a mean reversion play because you know that the brand is strong enough that if they address their fundamental factors that are driving the stock price lower, you can get a tremendous upswing as opposed to investing in companies where the stock is falling for fundamental reasons and the brand is falling alongside it, and the company is going to have a lot of work to do in order to reclaim their former glory. So by finding that divergence between the two, between the realized value and the unrealized value, it allows us to better capture alpha as a satellite portfolio by picking on those stocks or identifying those stocks that represent the greatest opportunity.
Yeah, let's talk a little bit about the sector breakdown here. It seems to me that a brand-focused strategy will naturally skew away from some hard asset segments, say utilities, energy, that sort of thing, and it's going to zero in on some more consumer-centric industries. Do you find that to be the case in practice?
That is the case, but not entirely. This is not a consumer fund. Right now, consumer cyclicals represent 34% of the fund. We do have 2% allocated to basic materials and 2% to energy, so there's a bit of a tilt, but not to the level where it's entirely a consumer's fund. And if you think about it, brand matters very much obviously for retail companies, or if you're buying a pair of shoes, it's quite important. But if you're selecting an airline to fly on, are you going to go with United or are you going to go with JetBlue? All things equal, I think most people would pick the latter because, among other things, but because of the brand. That's a big part of it. And as you go down the list, if you look at healthcare and you look at technology and you look at industrials, you'll find those opportunities to identify companies that have tremendous brand value, even in different sectors outside of the consumer space.
And do you find something similar for a market cap perspective? It seems to me that large caps, those most well-known companies like your Apples of the world, might have the more durable and popular brands, but maybe they're not going to be as undervalued, I suppose. So what's the kind of market cap breakdown you see for BVAL these days?
Well, we have some large cap companies. We also have some small and mid. We do skew large cap, and one of the reasons is that familiarity is a factor that we look at in terms of valuing the brand. And we have to do so because it's just hard to get a sample size of data for a company that's not as well known. So, for example, if I told you about Oshkosh, many people would think of the clothing brand and not, the company that does parts for trucks. So familiarity becomes a big part of the score, and as such, we tend to skew large cap. But there are opportunities to invest in companies further down the cap chain that do have those great brands and great opportunities.
So I also wanted to talk about some of the components that are in the BVAL fund these days. And so, American Express, there's some other well-known names in there like Boeing, American Airlines. But I also saw that there was Denny's and Blooming Brands. And, that was kind of surprising to me. I mean, does the Blooming Onion at Outback Steakhouse really have that undervalued of a brand? It was kind of surprising to me. So were there any companies on the list that you were surprised to find on there, either good or bad?
Yeah, you know what? Some of those same names, Xerox as well, was a bit of a surprise to me. But, that's the beauty of working with a large data set and a large sample size, that I might agree with most of the names. I might not agree with all of them, but we're looking at a sample of well over 10,000 influencers. So we have a large enough sample that I personally might think against the consensus on a certain name, but I trust the consensus more than I trust myself. So maybe I've had a bad experience at a certain airline or company or a restaurant or whatever it is. That doesn't mean that the large majority of their customers have shared that same negative experience. So using the large sample set allows us to pick stocks that we might not pick if it was just a portfolio manager making these decisions willy-nilly.
And another thing I want to touch upon is you guys have there's a different product you're involved with, ACSI, the American Customer Satisfaction Core Alpha ETF. And that fund sort of focuses on a somewhat similar area of companies that are satisfying their customers. So do you feel like there's any overlap between strong brands and satisfied customers?
There is. I think both strategies really fall into this intangible asset space, and they really solve a problem for investors, which is that investors are unable, with the current tools that are out there, or until these tools have come out, investors have been unable to capture intangible assets and to benefit from these data sets of intangible assets in their portfolio. So the ACSI ETF measures customer satisfaction, and it measures specifically the customers of each company, and it's across all sectors, so it's more of a core holding. The brand value ETF is an equal-weighted portfolio of 50 stocks. It's more of a satellite position, and the two complement each other quite well in terms of use in a portfolio, but also in terms of what they are. Brand is a big concept, and brand looks at the perception and a lot of different intangibles that are measured independently, whereas customer satisfaction measures very narrowly and very specifically how are your existing customers reacting to the service or the good that they're receiving, and it's more of a measure of recurring revenue.
To me, it seems like a company, Apple, for example, they might derive a decent portion of their brand value from their ability to consistently satisfy customers over time. Do you think that's a fair statement?
Absolutely, for sure. If you look at the products that compete with Apple, they've fallen short in a lot of cases because of exactly that. I remember when the iPod first came out, that's how old I am, I had something called an Arcos jukebox, which was an MP3 player. When they were called MP3 players, after a while, they started to become called iPods. And I couldn't figure out why this Arcos was not popular, and the iPod was. I for the life of me, I thought I had this great gadget, but the brand was so strong with Apple, and the brand identity and the loyalty of their customer base and the customer satisfaction of the whole experience. And when they started launching the stores, and then the iPhone, of course, and it was just something that the other technology companies could not compete with, and that was really how they built it up. Another example of that is Amazon. Amazon is not the only internet retailer, but they are the best at satisfying their customers. They have a fantastic brand, and based on those factors, they've been able to decimate the competition.
Yeah, and I also just wanted to say, I don't think you're really dating yourself by talking about the iPod there. That wasn't that long ago, so don't feel too bad about that one. But is there anything else you think investors out there should know about this concept of investing in undervalued brands? And is there anything on the horizon that you can discuss that's coming from Exponential ETFs down the pike later this year or maybe even next year?
Our core thesis at Exponential ETFs is that there are ways to look at the market that are better beyond market cap weighting, where people can do better for their clients, they can do better in their own portfolios, and they can do better using evidence-based approach, rules-based approach, or approaches that have an informational advantage that we think are going to be as valid 20, 40, or 60 years from now as they are today. So we do have quite a few products in the pipeline, all of which are going to be reflective of exactly that thesis, and we're pretty excited about the future.
We will definitely have to be on the lookout for that in the future. Phil, thanks for coming on to discuss the brand topic, and great to have you on the podcast once again.
Thank you, Eric. Much appreciated.
All right, everyone, that was Phil Bach, the CEO of Exponential ETFs. The fund that we discussed at length was the Brand Value ETF, symbol BVAL. You can check out more information on the index at brandometry.net or the fund at brandvalueetf.com. Well, hope you enjoyed this edition of the Duchin Report, and make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find and review the Duchin Report on iTunes. And if there are any topics you want us to discuss, feel free to reach out at podcast@Zacks.com, my Twitter page @EricDutram, or leave us a comment over on Facebook as well. But be on the lookout for a new edition of the Duchin Report each and every Thursday. But until then, for Zacks.com, I'm Eric Dutram.